Welcome to Get Rich Education. I'm your host, Keith Weinhold. If you've bought your first 10 residential rental properties, well then, if you want to grow your portfolio further, what comes next? I've got a bunch of material for you here. Then, for the first time, we're going to discuss family offices. Next, where can a beginner start in real estate investing? And finally, I've got a crucial update to your retirement plan today on Get Rich Education. Hey, is your IRA in a real estate syndication? Yikes, a 37% UBIT tax could hit you, but you still have a chance to set up your EQRP and avoid this. Did you make too much money in 2020 and need more deductions? Now federal law lets you set up an EQRP in 2021 and get deductions for last year, retroactively. Even put old IRA and 401k money in Bitcoin, gold, or your own business. Get control of all of your retirement money, tax and penalty free. Text EQRP in all capital letters to 72,000.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE. I'm your host, Keith Weinhold, here on episode 330. Hey, well, let's say that you bought your first 10 financed properties at those best mortgage interest rates and terms, like you can. Well, then what comes next? What's down the road? Well, depending on whether you've put single-family homes or duplexes, triplexes, fourplexes in your portfolio, well, then is 10 doors up to 40 doors? Is that enough for you? And, well, maybe it is if you're looking to build some extra residual income on the side of your life around your day job, and then nothing more than that is needed. Great, that might be enough. Though you might want more than that, and you might wonder what is next. Now, when it comes to these properties, your first 10, you might remember that 7 weeks ago, Chaley Ridge updated us. If you want more loans than that, then it's about a 2.5 percentage point bump up in your interest rate. And although those terms might still work for you, it sours the deal. It wasn't too long ago that there was only about a 1% margin there. So let's look at some alternatives here if you want to own more property. Of course, twice already this year on the show, we've discussed fourplexes. This helps optimize your borrowing power. If you have all fourplexes, then you can have 40 doors single, 80 doors married. And if you want brand new construction fourplexes west of the Mississippi River, get started at getricheducation.com/fourplex. Or for brand new fourplexes in the Southeast, start at getricheducation.com/Southeast. Another thing that you can do with a single family home is convert it into an assisted living home. Yeah, you can get more than $10,000 of monthly cash flow. Yeah, not gross income, but monthly cash flow from just one single-family home converted into an assisted living home. But going this route is not so passive. It's more of an active business now. You would expect to have employees. And I have done 3 episodes here in the past on just how you do that and what kind of property makes the best one to convert into an assisted living home. That's kind of a hybrid real estate with a business there. Now, when you think about how to grow your portfolio, well then, larger apartment buildings are one thing that you need to think about. In a lot of cash flow markets, a 10-unit apartment building, now say that could cost you $1 million or something like that. And that could cash flow, say, $2,000 a month for you. Since it's going to take a 25% down payment on your part, give or take, well then for you to buy this $1 million 10-unit apartment building, coming up with that $250K down payment has got to sound daunting. But look, it really is not. In fact, historically, you can get a good chunk of that $250K without trading your time for dollars at all. I would know that because I have operated exactly that way. Now, how do you do that? Well, of course, you know what we do here. You will utilize other people's money in an ethical way with leverage and the addition of time, but not even all that much time. In fact, if we just drop back and you start out fresh from scratch, say you didn't own any properties yet, if you begin with just 20% down payments on each of 5 $100,000 cash flowing properties, okay, you've outlaid $100K. Just at real estate's historic appreciation rate of 6%, your $100K turns into $300K in only 5 years. How does that happen? Again, it's with financial leverage because you get the gain on the entire property value, both your skin in the game and what you borrowed. I'll tell you, that's leverage over compound interest, and I'll put a link in the show notes about an article I wrote on this so that you can see the math. I'm not going to cover all that math, and of course, there are no guarantees that this happens. It's just typically what happens on average over time, and in fact, appreciation rates have been even greater than their historic norm of 6% lately, so you could turn your 100K into 300K in less than 5 years. Okay, so after 5 years, with 300K of equity in your 5 properties now, just letting leverage do its thing, let's say that now after 5 years, it's time to sell them all because you want to do a tax-deferred exchange. You want to trade these 5 little green houses up into one red hotel, like the game Monopoly, but in this case, that red hotel will be your $1 million apartment building. But see, from your 300K that you built from 100K in just 5 years, you're going to have some sales expenses on that 300K. So we're going to whittle your 300K down to 250K. Well, there you go, 250K. That's a 25% down payment on a $1 million apartment building. That's how I got into my first few larger apartment buildings, by leveraging smaller properties, paying 0 tax on the capital gain when I sold, and went ahead and exchanged up. And it sure wasn't for me like saving 250K by myself in a savings account. That would be nuts. That could take most people both a lot of years and a lot of lifestyle sacrifice. I am not interested in that. Now, another way to grow your portfolio beyond your first 10 financed residential properties is with what is called real estate syndication. And syndication, it's kind of a weird sounding word. It throws off beginners. They think of television companies selling broadcasting rights or something else. Or maybe they think of the mob and some sort of crime syndicate. Okay, that's not what we're talking about here. Real estate syndication, that typically means that with very little of your own money, you can buy a big, say, 100-unit apartment complex that costs $15 million, just say. And that is because a syndicator, being that, is what you do is you perform the due diligence and the research in identifying this, say, $15 million apartment complex to buy. And what you do is you attract other investors to come alongside you in order to share in the returns of the building with them. You all share in the returns together. So your role as a syndicator, besides identifying the deal and attracting the investors, is to have some of your own money in the deal. In fact, when you show that you're going to put a little skin in the game yourself in that property, well, that helps attract other investors to you because it shows those investors that you believe in yourself. See, now investors can believe in you because you've demonstrated that you believe in you. As the syndicator, you also get an outsized share of the building's profits for putting the deal together. So being a syndicator, yes, it is a more sophisticated role for sure. Oftentimes, you need the ability to attract more than 10 investors to your deal, even dozens of investors to your big apartment complex deal that we're talking about here. And they often need to be both accredited investors and have a minimum to invest. A minimum of 100K is a pretty common minimum for those that are investing in your syndication, this deal you've identified. And there is also government regulation when you go big and syndicate this way. There are often certain rules that the SEC, the Securities and Exchange Commission, sets forth when you're going out and you're attracting money from other people. But in a nutshell, that's what real estate syndication is. You're going big when you're syndicating properties. Now, there is a live 2-day training to be a real estate syndicator that I recommend because I've attended it myself. It's called the Secrets of Successful Syndication Seminar, and it's put on by the real estate guys, Robert Helms and Russell Gray. In fact, you've heard them here on the show discussing that very topic before. Coming up on the show here in the next few months, I'm going to have some apartment syndicators on the show to discuss this a bit more. Consider that for someone to ever invest in your big $15 million apartment building syndication deal, it's almost mandatory. It really helps if, first you have experience with your first 10 residential properties. Just think about that. If I were an investor out there and you were trying to attract me and I were going to invest in your deal, well, I would want to know that you've had some track record of success with at least some smaller properties first, and having had experience with owning those properties in multiple states is going to be a real credit to you on your resume. Being a successful real estate syndicator, that also means that you've already built an existing network of like-minded investors, and you're probably even spending a few years in building up your brand. You would need more than just a website, but something like writing and having published industry articles in respected publications, that's really going to help you out here. Having your own dedicated social media page for your investment company, all dialed in on the right hashtags to use on social media and platforms like that. So that is a quick overview of real estate syndication. So that's a more sophisticated route to go. We're talking about how to grow your property portfolio today. Another way is if now you're really focused on just the cash flow component of the up to 5 glorious simultaneous ways that real estate pays you, and you want to keep things low hassle, then what you can do is private money lending. And that doesn't take up any of your 10 golden ticket residential loan spots. That is because you are actually the one making the loan here with private money lending. Real estate then is your collateral during the time in which you're making the loan, and you've got that collateral in order to ensure that you do get paid back by your borrower. And that is a new mindset to a lot of people. That turns a lot of things upside down. So therefore, rather than investing in real estate on the equity side like you're used to, you invest on the debt side, and you often get a monthly income stream based on an 8 to 10% annual return. And the funds that you loaned expect to be returned, often on a 12-month lending duration. That's what's agreed to upfront. It's typically a period of time of about that length. People love private money lending. It takes $50K to $100K to get started with this, though. And it's also a good route if you have busted credit, because no credit check is needed. You don't have to be holding on to reserves or anything. And again, of course, no credit check is needed because you are the one making the loan, not taking out the loan. In fact, I've helped lead people to Freedom Real Estate Group. The principal over there, Danny Lynn Robeson, is the person that pays these hassle-free returns with private money lending. She sits with me on the Forbes Real Estate Council. You can get started at getricheducation.com/lending there. Another way to grow your portfolio is with agricultural real estate. And the upside to this is that with crops and with timber, there are no tenants that ever move out or need to be managed in quite the same way. Of course, agriculture still needs a little management, like pruning and such. We've talked on this show about a few different crops: coffee, cacao, and most recently, teak hardwood trees. The upside is that you're getting pretty well diversified now as you're tilting a little of your portfolio out of residential and into agricultural. And one downside is that there is no leverage. There aren't going to be any loans with agricultural real estate, typically at this level. And then, though there are no loans, you can sometimes get started for under $20K, even under $10K in some cases, like with the teak hardwood. And you also get full title to the land, these parcels with teak trees growing on them. Although you don't get annual cash flow from the teak hardwood like you do with some other crops, you've got to remember that your asset can grow two ways at the same time with this timber. You can get appreciation in the value of each board foot, plus the tree grows, so you also have more board feet every year. Actually, more people have been buying these teak hardwood trees in Central America lately with the advent of the recession and the civil unrest, and you can even use retirement funds for them. You can learn more about that at getricheducation.com/teak. That's TEAK. If that sounds interesting, we've done a couple episodes on the show here about that too. We're talking about ways to grow your real estate portfolio once you've already got your first 10 finance properties, those single family homes up to fourplexes. Let's talk about one of my favorite investor metrics, that ROTI, your return on time invested, with what is called a family office. Do you know what a family office is? It kind of sounds like two words that don't go together, doesn't it? You think of your office life and your family life as maybe two very separate and distinct things. Now, if you're really vaulting into the financial stratosphere, you might have your own family office. In fact, in a bit, I'm going to tell you how much your cash flow or your net worth would need to be in order for you to have a family office. What family offices are basically private wealth management advisory firms that serve ultra-high net worth investors. That's what a family office is. So they're different from, say, your Edward Jones or your traditional wealth management shops, because family offices offer a total outsourced solution to managing the financial and investment side for an affluent family, or maybe even one affluent person. And you might be wondering, physically, what does a family office look like? You might be conjuring up visions of fancy desks with a shiny, deep mahogany finish, or maybe some marble globes of the world on tables, or busts and statues sitting around. Well, you might see some of that, but you're more likely to see big computer monitors. A family office can have just a few people in it, or even up to a couple hundred. There really are a wide range of family office models. There are single family offices, and there are also multifamily offices, and those would serve several unrelated families. And don't confuse this with single family and multifamily property. A single family office serves just one family then in carrying out that one family's financial affairs. And family offices, they slowly began springing up in the 1800s to help manage the fortunes of wealthy families like the Rockefellers. With more proliferation of wealth, there are more family offices today. And it's kind of like having your own personal CFO. I mean, that's really what it is. And hey, maybe it's a goal of yours to have a family office to manage the major investment affairs of your family someday. You might just have to change your name to one of those rich-sounding names like Alistair or Carruthers, right? If your old friends know that you have a family office, you might be catching some heat for that. So anyway, getting back to your return on time invested, right now it is pretty likely that you either manage your own properties or you have property managers in various metro markets that manage them in those geographies. And you can think of yourself then, right now, as you are the asset manager presiding over each one of your property managers. Well, I think then of family offices, they serve as your asset manager. So then it could be your family office staff presiding over your property managers and all of your investments. Therefore, your family office, they might make the decision to renovate an apartment unit, and your property manager in, say, Ohio would then administer over the contractor's work. Maybe you've never heard the concept family office before. I didn't learn about it until I had invested for years. And a big reason that so few know about it is because family office service can cost about $1 million a year. So for a lot of people, it's going to make sense to have assets of at least $100 million in order to make this whole concept worthwhile. And hey, sometimes you got to dream big. Right now, as a direct real estate investor, even if you have property managers, you're going to have to deal with a few bumps that arise from time to time. Being a direct real estate investor and owning residential property titled to you is awesome. When you buy right, you are often feeling all 5 of those profit centers. And right now, you might be doing things like using a laptop on your sofa to confirm with the property manager that, yes, you are going to agree to replace that 20-year-old dishwasher in one of your rental properties. Or you might find yourself in your car using your iPhone to take a photo of a paper check and then deposit a $1,200 rent check with your phone that way. And you know what? Those activities right there that you're regularly doing, You can think of that as running your own small-scale family office. You're kind of doing your family office duties as you're tending to your own investments. But yeah, direct real estate investors feel the bumps. If you're invested in stocks and you don't have control, you don't even know that the bumps occur, and that might be worse. You can't control them. You don't know how to handle them. What if the stocks of one of the companies you're invested in, that company has some trademark infringement lawsuit and they end up losing money on that? You might not even find out about it. So these things are happening in that world as well. But yeah, direct real estate investors, they feel the bumps. You're going to know about them. In fact, one of my out-of-state rental properties, gosh, this is an awful story that just happened. It's a single-family home. It was struck by an out-of-control pickup truck that crashed and ran through a fence, and then it slammed into the block wall of the home itself. Thank goodness that none of the residents were hurt, because the family actually was there when the car struck the home, and it did a lot of damage to the kitchen, and it needed all new cabinets and some appliances, and there was actual structural damage to the wall. This happened last March. All right, well, you know what else happened last March? Government-forced shutdowns started almost the exact same day that this truck struck one of my rental homes and ran right into it, almost through it. Well, the timing coincidence, which was awful, it made it hard to get contractors with these shutdowns. The county permitting offices were often closed. We just couldn't get the work done for a really long time. It got frustrating. This ended up being a 9-month ordeal until the property was finally renovated and new renters were finally placed just a month or two ago. Ridiculous. Now, insurance paid for all of the expenses. I didn't have any out-of-pocket costs, but it took me dozens of phone calls to my property manager there to try to help coax and motivate the contractor to get the renovation work done. See, that's the type of thing that a family office could do, especially if we're talking about a bigger property. And by the way, if you're a new investor, I'm telling you this because I want to let you know that this type of freaky real-world stuff can happen, but that is definitely not typical. I've been doing this over 18 years, and that's probably the strangest event that ever took place. Totally weird event. Just crazy. It coincided with the start of the virus-related shutdowns. Hey, but one sweetener on the deal is that with this surging demand for single-family homes right now, I got $1,200 in rent before the truck incident, and then after the renovations, the manager found new tenants, and we got $1,350 in rent. That was a really nice jump up, and rent increases are typically not that dramatic, and either is the event itself. The event itself is just such an absurd outlier, and insurance typically pays, and they did in this case, they pay for the rent while the property is vacated and the renovations are taking place. Well, hey, I've been getting a lot of praise from GRE listeners here lately. Thank you for that. It's so good to hear it. But I hope that you are not giddy about how good real estate investing has been for you just because prices are up so substantially lately, especially on these high-demand rental single-family homes. In fact, as I've said before, the median single-family home price was up 11% per year last year with Freddie Mac data. I also told you that no one really knows, but I doubt that they're going to rise quite as much this year. Well, in just the past couple weeks, John Burns Real Estate Consulting released their home sales price forecast, and they basically agree with what I said about a month ago. Prices will not rise as much this year as last, according to their projections, but they're still going to rise, and they're still going to rise more than usual. According to them, existing home prices will rise 8% this year. New construction home prices are expected to be up 9%. But back to the feedback from GRE followers here. I'm glad that you're happy about this great appreciation we've had lately, but hopefully you're generally buying for cash flow and you would be just about as pleased overall, even if property prices were flat. So let me just share 2 pieces of listener feedback with you here. The first one is from John in Minnesota. He says, "Hi, Keith. I just wanted to say thanks for all your help, insight, and guidance, even though we have never met in person." Then John goes on to write about how he had expected to meet me where I was speaking in Alabama last year, but the COVID pandemic knocked it out. John goes on to write, your podcast, blogs, and articles are the best out there. I think I stumbled across your podcast in 2015 sometime, and I have been hooked on it since. At that time, I was working at a job I didn't care for, putting in 60-plus hours a week, and no investment nor passive income to speak of. 5 years later, my wife and I are up to 10 units in the U.S. Hey, great job, John. And they are in Minnesota, Arizona, Tennessee, and Alabama. And we've got a coffee farm in Panama. In 2021, I'm looking to add another property from Mid-South homebuyers and expanding into Baltimore and Paraguay. Thanks again for everything. Sincerely, John. And then John even sent an Amazon Kindle gift card through the mail. Super nice. The next message is from a different John. He and his wife Debbie live in Sun River, Oregon. This John says, Dear Keith, I am a regular listener to your podcast, and the value of the knowledge that can be gained became very apparent recently. My wife and I have sold 7 rentals this year, not doing a 1031 exchange as we ended long-term partnerships. My CPA estimated the impact to be an $85,000 tax bill from capital gains and depreciation recapture to the feds and the state of Oregon. I knew the day of reckoning would be coming in April 2021, but then I listened to your podcast with guest Dave Zook after some due diligence in my CPA's review. By investing in his ATM fund this year with the bonus depreciation and applying the monthly income to pay off the tax bill on my line of credit, the $85,000 tax bill will be completely gone, and I will have about $13,000 more in the bank in 7 years. Wow, that is awesome. John and Debbie go on to say, the total impact of listening and then applying what I learned in just one podcast episode will make a $98,000 difference in our bank account, not counting the time value of money. Thanks for your podcast with such varied guests, and I wanted to thank you for having Dave come on. All right, that is from John and Debbie in Sun River, Oregon. I really appreciate the praise there. Hey, if you've got praise or concerns or any feedback, you can either leave a voicemail or email through our contact page at getricheducation.com/contact. I've been talking about growing your real estate portfolio larger today, especially for when you get beyond 10 residential loans if you're single, 20 if you're married. If you're a beginner, I'd really like to encourage you to get going with the mindset of go as far as you can see, and when you get there, you'll see further. As a beginner, be mindful that real estate has some built-in guardrails for you so you don't spill over the side and crash, okay? Lenders will not give you a loan unless they believe that you can afford it. So the lender examines your income, they look at your past credit performance, and they look at your repayment ability. And you can also take comfort in something that actually was not a common practice in real estate 40 years ago, and that is the home inspection, where an inspector physically goes around and addresses your property's health and safety issues and even maintenance and cosmetic issues before you even commit to buy it. And then the prospective seller has got to fix those things for you. And remember, an existing home is always going to have wear and tear. You just don't want to be too picky. Understand that even a new construction home is going to have some inspection findings. What you're doing when you buy cash flowing real estate is, in most cases, you turn a profit in just 1 month. You do that when the property income exceeds the expenses. Look, consider this. It took Tesla 17 years to turn a profit making cars. 17 years. And Tesla is a company that a lot of people respect, but yet it's only taking you 1 month to turn a profit, and with substantially lower risk than a business startup would have. You're just 100x what Elon Musk did. Well, kind of, in a small way. If you're a beginner, 2 good resources for fully renovated single-family rental properties are with MidSouthHomebuyers.com. They serve both Memphis, Tennessee and Little Rock, Arkansas. And their purchase prices there are often between $90,000 and $100,000. They have rent-to-price ratios of about 0.9%, which can really work well with today's low interest rates. But the word is out. They are so popular that they are going to have a waiting list for properties there. And another choice is our preferred provider in Dayton, Ohio. When the trucking company U-Haul recently released those state-by-state in-migration data findings to see where people are moving, the state of Ohio ranked the fourth highest for the most one-way arrivals, minus departures. Tennessee was first for the in-migration there. And in the Dayton area, which is southwestern Ohio, you still get around a full 1% rent-to-price ratio. Yes, even in today's market, often about $1,250 in rent for a $125K purchase price. You might just still find that there. With today's low interest rates, really, that ratio might be like getting a 1.2 or 1.3% ratio just a few years ago, and there is little or no wait list there in Dayton. If you think that might be for you, you can get started there at getricheducation.com/Dayton. I've got a retirement plan update for you next as a great guest drops in. I'm Keith Weinhold. You're inside episode 330 of Get Rich Education. Most rental property investors choose either cash flow or home price appreciation, but one real estate market can give you both. Jacksonville, Florida, with 27% lower home prices than the national median, 1% higher gross rents, and Jacksonville has appreciated 34% more than other comparable cash flow markets over the last 30 years. Get positive cash flow today and appreciation for tomorrow. To invest for cash flow and growth in Jacksonville, go to cashflowandgrowth.com. The people that our listeners can't stop talking about are Ridge Lending Group and MLS 42056. They provided you with more loans than anyone. It's where I got my last few loans, and they finance single-family income property up to fourplexes. They're the number one lender for both beginners and veterans. Start your pre-qualification, chat with President Chaley Ridge personally, and you'll end up with your custom plan for expanding your cash flowing portfolio. Start at ridgelendinggroup.com.
This is JWB Real Estate Capital's Greg Cohen. Listen to Get Rich Education with Keith Weinhold and don't quit your daydream.
I'd like to welcome a guest you're familiar with. It's Damian Lupo. He owns the EQRP company. He's a really smart tax strategist, and he's also the host of a podcast that you really ought to consider listening to, Financial Underdogs Daily, Monday through Friday. Damian, welcome.
Keith, good to be here, man. Thanks for having me.
Damian, you've helped so many of our people on the show with the EQRP, the Enhanced Qualified Retirement Plan. And I think a lot of people, when they first start to work for an employer, they have a 401k or a similar type plan. Some of them, though most don't, along the line, though, they learn about a self-directed IRA where it opens up an entire world of new investments beyond just Wall Street investments and into Main Street investments. But actually, those that invest in a SDIRA, a self-directed IRA, are often missing out on some of the benefits of something that even they don't know about, the EQRP. Tell us about what makes an EQRP better than a self-directed IRA and a 401k.
Well, the big difference is you have actual control. So an IRA, there's always a custodian, and they can be really pesky and annoying. Nobody ever rants about how great their custodian is.
Right.
And when you have an EQRP, you're able to control. So you have the checkbook, and this is for you if you're by yourself or if you have a job or you have employees. It gives you control of the money to invest in real estate and gold and crypto and all these things that are really not allowed with the typical 401k. So you do have control, and you get to avoid that UBIT tax that we've talked about a lot if you're doing real estate, because real estate is a big target for people. And if you want to self-direct your retirement accounts, you do not want to be using an IRA in most real estate deals because you're going to pay up to a 37% tax, and it's totally exempt and zero with an EQRP.
Wow, that is just giant. So UBIT, unrelated business income tax, which is up to 37%. It's a bite that a lot of people in self-directed IRAs do not see coming. The EQRP exempts you from all that. So tell us more about that, because I know that you have been doing this for people for years. And I know, Damian, you've saved some people $200,000 in UBIT taxes when they moved their IRA that was in real estate investments over into an EQRP.
Yeah, what has happened is nobody told them, and there's not really an obvious website that says you're going to get hit with this. A lot of people invest in real estate and they have some debt, or maybe it's a personal project or it's a syndication that they've invested in, and there's typically debt. And so what's happened is people will invest $50,000 or $100,000 in these deals, and then 4 or 5 years later, these deals cash out. There's a big yay moment where money's coming back, At that moment, this UBIT tax comes up and bites them in the butt. And their accountant says, guess what? You owe 37% of this profit. And so people say, I made 100,000, but then they have a $25,000 tax bill. And here's how we fix it. We move the asset from the IRA custodian over into the EQRP before it's sold. And at that point, it's exempt. So just because you have something in an IRA doesn't mean that you're dead meat. Only if you don't take action are you dead meat.
That unexpected tax is like a ticking time bomb for some people, and there is a way to keep that thing from detonating. Another advantage of the EQRP that I learned about a few years ago when I first met you is that the contribution limits are also substantially higher than what you get elsewhere. Tell us about that.
Yeah, so an IRA, contributions by themselves is a 10x difference. IRAs, you can put $6,000, maybe $7,000. I mean, whoop-de-doo if you're over age 50. But with an EQRP, it's 10 times more. It's 58,000. And if you happen to be 50 or over, it's 64,500 per person. And so if you think about that, that's per person. If there's maybe a spouse in the household, you double it. If you have kids, you can contribute to them. Potentially, you could have hundreds of thousands a year. And something I know that we want to talk about today is if you looked at your 2020 income and you said, oh man, I had too much income. Guess what? The laws changed for 2021. We can actually set up an EQRP now for last year and make contributions to drive your income down. Basically, if you say I made too much money, we can give you a tax deduction potentially up to 50, 60, maybe even 100,000 for last year. It's called tax planning in reverse, retroactively.
Yeah, and there's still a chance to catch up. So we're talking about reducing your AGI, your adjusted gross income, and getting tax deductions on the difference there. Tell us more about some of those deadlines. Are there deadlines for the retroactivity for going back to previous years and claiming the benefit?
The deadline, this literally changed. This became available January 1st, 2021. So you're able to set up a plan and contribute, and you have to do the contribution and the setup before you file your taxes. So if you're filing by April 15th, then you have to set up the plan and fund before April 15th. If you're doing an extension, you've got to do this before, say, October. So you've got some time. Sometimes you don't even know what's going to happen until after the end of the year. So this really does give people a chance to lower their AGI, which might also give you some benefits if you, let's say, we're trying to get below the 157,000 for the qualified business income. This could push you from, say, 200 down to 150. This is a great conversation to have with your tax strategist at your accounting firm and bring all this stuff together because you may be sitting on some serious tax deductions that you didn't even know about.
Some say there are two tax codes, one for the rich and one for the poor, and I think there's a lot to be said for that, but it can probably be said better when you think about the fact that there really is a tax code for the advised and another tax code for the ill-advised. So you're getting advised right now on what some of your options are. In fact, Damian put together a book for you called the EQRP Book. All you need to do is text message 4 capital letters EQRP to 72,000, and he'll make sure you get a copy of that book so that you can read more about it because you probably have some questions. What's interesting, Damon, is I know that in practice, sometimes you might have people from a self-directed IRA coming over to the EQRP. Other times you have people from a 401k or maybe a 403b type plan coming over to the EQRP. Your staff there at the EQRP company goes above and beyond. And sometimes a lot of these custodians, they don't want to part with the money that they have in these more conventional type plans. Your staff will get on the phone and more or less wrestle it from them and make sure that the investor does get control of their funds. Tell us about that.
It's one of the things that's very unique about what we do. We're the only ones that will sit on a phone, and we don't just maybe do this. This is part of our onboarding, our client startup process. We get on the phone with our client and their custodian or the trustee of an old plan, and we'll make sure that that money gets unwrangled and unshackled out of Wall Street jail so that they have the money rolled over. Custodians and trustees in general are not very friendly when you pull money because guess what? They lose fees. And so they don't want to let go of it. They want to treat you like you're too stupid to have your money, and they want to treat you like you wouldn't know what to do with it anyway. It really frustrates a lot of people. They don't have that experience when we're working because we just grab the money for them and we make sure that we have 100% success in this space. And so people don't have to sit there and go, I hope this works out. You don't have to smoke hopium in this process. Like, we're going to make sure it happens. It's part of our unique experience for the clients.
Damian's representatives have that wrestling headgear nearby for when they need to get in that match with that more conventional custodian. Well, Damian, is there any last thing that someone ought to know about the EQRP, how they're utilizing it in practice, or how they're getting the tax savings, or what they're investing in that they thought they couldn't? Any last thing someone should know?
Yeah, I think there's a couple of things. One, something that happened last minute right before Trump left office in 2020, there was a reconciliation bill that allows people to continue on to CARES Act stuff. So if somebody says, well, I wanted to borrow money out of my retirement account, I wanted to borrow $100,000, guess what? You actually can, up to 100%, up to 100,000, whichever's less. You can do that between now and you're watching this and March 21st. So many 401ks have ability to borrow 50,000. Right now, you still have the ability to borrow up to 100 and not make payments for a year. So this is a pretty cool way to tap in to some of the money. And the other thing they did is they extended the ability to disperse up to $100,000 and then spread the taxes over 3 years on that because of any disaster, including coronavirus. And there's no penalty. So if you're 40 years old and you want to pull out 100,000, you could pull it out of a 401k or an EQRP. Again, those are only available till March 21st, given the current legislation. I think it's just important for you to realize that this is a complex space, and to have advisors is the priceless thing. Having Google is the confusing thing. We're here to be an advisor and a guide and help you make really good decisions. That starts with getting informed, which you can do with the QRP book. And like you just said, going and texting EQRP, all caps, to 72,000 starts the ball rolling with your education.
Damian, it excites me just to think about how valuable this is going to be for a lot of people. If you're interested, you owe it to yourself to at least maybe learn a little bit more. If you think you can benefit from it, text EQRP in all capital letters to 72,000. Damian, it's been valuable as always. Thanks so much for being here.
Thanks, Keith. Appreciate you.
Oh, a great update there from Damian. If you want to invest in real estate or real physical gold and silver or crypto like Bitcoin or other people's real estate syndications and a lot of other things and still maintain control, then this could very well be for you. You can also invest in tax liens, business startups, foreign real estate, LLCs, private loans, and the contribution limits really are pretty staggering for a retirement plan. The updated part of the EQRP here today is the retroactivity for last year that you can enjoy if you do this before you file your taxes this year. Hey, well, from apartments to syndication and agriculture to the EQRP and more, here's hoping that you got some good ideas for growing your portfolio today. Until next week, I'm Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.